my role at RBC Capital Markets, my main focus is analyzing fixed income and currency markets from a technical perspective and across our global client base. So it does involve a lot of marketing to clients on a global basis, a lot of travel requirements to meet with clients and present our views. And in terms of the methodology, I think there's been an interesting evolution in my methodology over the years where I've always used the basic tenets of technical analysis. So generally my starting point would be, for example, a candlestick chart where I overlay pattern recognition, so looking for triangles, rectangles, double tops, triple tops, etc. Because they're an important part of the forecasting process. When I see those patterns break, those tend to be the basis in terms of my price objectives for whatever instrument I'm looking at. So a lot of classical Edwards and McGee pattern analysis. And then what I like to do is overlay indicators on top of that. The preferred indicators that I like to use generally revolve around momentum, RSI, and the slow stochastics. And I basically use them in two ways. The first way would be to identify your traditional overbought and oversold conditions. But more importantly, I think what has more relevance to me is when we start to see divergences form on those studies. That to me increases the probability of at least some sort of price correction. And so that's got important implications for asset managers in terms of risk management, stop loss placement, trade timing, etc. So that's sort of the basic methodology that I use across markets. And then over the last couple of years, what I found is I've started to become a little bit more quantitative in my approach, looking at correlations, for example, between instruments and across asset classes. And also more recently, using fusion analysis, where I would apply some of the basic technical tenets to some of the economic data, such as the unemployment numbers, housing starts, building permits, etc. I think that's one of the big opportunities that we have as technicians, is the flexibility to look at new tools, to create new tools, and to apply these tools to data sources that perhaps in the past people wouldn't have considered as being a purely a technical type of analytical approach. And so, for example, the economic data. Even today, when I show clients some of these charts, you do get a lot of skepticism in terms of, how can we overlay trend lines and retracement levels and things of that nature onto, the U.S. unemployment rate or things of that nature. But what I'm more looking for is bigger picture macro signals, where, for example, if some longer term uptrends or downtrends get broken, that's a very important macro signal in terms of whether we expect the economy to improve or to regress. And so I generally tend to use those indicators more so as macro indicators for bigger picture trends and themes, as opposed to very specific trading opportunities per se. Because one of the things I found is over the years, since the credit crisis in particular, our client base has been more proactive in using technical analysis to develop a macro approach and then work top down. Whereas I think before that, a lot of people would sort of use technicals for timing and execution. So it would be more sort of the bottom-up type of approach. And so I think as that approach has changed, we've adapted to how the client base views the world, and we're able to add value that way by introducing new tools, new relationships to watch in that context. There's definitely been, in terms of the structure, there's definitely been an increase in terms of communication with the client base. And I tend to think of my clients not just as external clients to the firm that we deal with, but also internally, i.e. the sales force and the traders. Because one of the most important things is to get acceptance of your research product, to build credibility with the salespeople and the traders so that they're willing to use it and add value, whether it's a trading strategy on the trading side, or whether it's marketing it to clients to help flesh out some broader themes that might be relevant to them. And so the communication certainly increased over the years. It's been very important in that context to have the dissemination of the research. But at the same time, it's been challenging because even though we do have dedicated technical resources as part of the research group, it's an extremely small group. There's basically two of us, myself and an associate on the fixed income and currency side. We look at commodities as well. And then we have another 3 people, or 4 people, including associates, on the equity side. So it's a very small group relative to the fundamental strategists that we have on the equity side and the debt side that are covering a number of different sectors. And so that creates some challenges at times in terms of market coverage, because what's happened over the years is we've seen the convergence in asset classes, low volatility environment. So when things move, we're seeing everything break at the same time. And so the challenge is, because we're a smaller group, trying to put out research and commentary on all these different areas that are moving at the same time is very difficult. And so one of the important things as part of the communication process is we've been very direct with our sales and trading teams to give us feedback in terms of what instruments are the most important. So if it's, for example, G10 currencies and global 10-year yields, when the markets start to break out, those are the products we'll look at first and foremost, produce reports on that, and then we can look at some of the other variables later on. And so that communication is very important, because what the client base is looking at changes and evolves over time. So today it could be 10-year global yields, but in 3 months' time, it might be the 30-year, or it might be curve spreads, or it might be emerging market currencies. We need to know that. And the salespeople and the traders are important touch points with the client base to be able to give us that feedback. So that's crucial in terms of how effective our product is in adding value. I think one of the key things for us has been an evolution where we've moved out of the silo type mentality where we're just foreign exchange strategists, we're just fixed income strategists, and we produce that type of research independently. What we've done is over the years we've developed an intermarket and cross-asset approach. So for example, if I'm writing a piece on dollar-yen, which has been in the news a lot lately in terms of the very sharp price move that we've seen to the top side, oftentimes what we'll do is we'll look across asset classes to see if there are any linkages. One of the interesting things right now is, as dollar-yen's moved, we've seen an equivalent move in the Nikkei index. So there's that cross-asset or intermarket relationship between those two variables that we'll often draw on and look at in our research reports. And we'll do that with fixed income markets as well, with commodity markets as well. We'll draw that into our research as components. And I think the advantage there is it gives clients not only a broader perspective, but it appeals to more clients. Because if I put out a report where the conclusion is mainly FX based, but I've incorporated equity analysis or commodity analysis or fixed income analysis, when I'm sending it out to clients, not only does it apply to a trader or a portfolio manager that's looking at FX markets, but it might apply to people in the interest rate area or the commodity area. So they will forward the report on to their coworkers and say, hey, you might want to have a look at this. So that cross-asset approach fosters a broader interest in the product. So we reach more people, we touch more people. And so that's one of the important, I think, value adds that it's brought to the table. And I think it's helped to a certain extent differentiate some of the product offerings that we have relative to some other institutions out there. I think that's one of the big lessons I've learned over the years as an analyst is it's not just a matter of coming up with ideas. Certainly ideas are important. That's where we can add value to the client relationship. But you can't just randomly generate open-ended ideas. And by that what I mean is you can't just go to a client and say, I'm bullish on the stock market, buy stocks. Because that client is a risk manager, a fund manager, a portfolio manager. And so when they look at that, their investment approach and their asset allocation process, they have to look at it as, okay, yes, we're bullish on equities. We think they can trade up to a certain price objective. But what's our risk tolerance? Where do we put our stop loss? And that's key because that'll determine whether or not you actually undertake the trade. For example, if you have a bullish equity view and you think the equity market might rally 3%, but then you start to look at your charts and you say, okay, I would place my stop loss at this level below the market, that might happen to be 2 or 3% below the current market. Well, now you're risking 2 to 3% to make 3%. So that's a one-to-one risk-reward proposition, which isn't that attractive. Now, on the flip side of that, if you've got a view and you say, I think there's 5 or 6% upside in this trade, and I would have a stop loss that's a percent and a half below the market, now you're looking at a 4-to-1, 5-to-1 risk-reward ratio. That's a lot more attractive. Those are the kinds of trade ideas that portfolio managers and clients will look at. And so over the years, I've made it a point when I'm working with people to make sure that we stress, yes, our view is bullish or bearish on a specific instrument, but also stress where we would put our stop loss and how that fits into an attractive risk-reward framework. Because again, bottom line is, clients are in business managing money to generate returns, and that discipline in terms of risk management and limiting your losses is key. And that's one of the basic tenets of technical analysis. If you find a trend, follow that trend, and the trades that don't work, that aren't trending, those are the ones that you want to cut out to minimize your risk. So it all kind of feeds back to that basic tenet. I thought the panel today was excellent in the sense that I think we brought really diverse viewpoints to the table, in the sense that we all had obviously different backgrounds, not only working with different asset classes, but also coming from different geographies, which sometimes has an impact on how you view the world. And I think one of the advantages for the attendees is the sense that not only were we getting equity-specific views, but those views were being tied into views in other asset classes. So in other words, what did the panel think about commodity markets? What did the panel think about fixed income markets, interest rates, quantitative easing, central bank intervention, how that impacts markets? And of course, what do we think on the currency side? And so I think it provided a broader scope for the audience. And I think it probably introduced a few new ideas in the sense that clients coming to the realization that yes, if I'm equity specific in terms of my job, I can still look at the other asset classes to glean some hints and some ideas in terms of how that might feed through and impact what I'm looking at specifically within my mandate. So it kind of helped connect the dots. So I think that was a huge positive for the audience and for us as panelists to get the different viewpoints from people with expertise across different asset classes. In terms of the questions, I think a couple of different questions with respect to daily routines and how each of us analyze the markets. You know, how many charts do we look at? How do we deal with the sheer amount of data that's available out there? How do we synthesize the data? What data providers do we use to do that? I think that was kind of interesting insight. And I think a second question from the audience was interesting in terms of potential opportunities in the field of technical analysis. Because certainly, you know, the people that are in attendance here and us being members of the MTA, I mean, we're trying to market the discipline, the advantages and the value add to the investment community. And so certainly job opportunities to do that are an important part of that mandate. And the answers were very interesting in the sense that if you look back to where staffing levels were 10 years ago, 15, 20 years ago, we've seen a significant shrinkage in the amount of people employed in those various capacities. I think some of that's been driven by technology, because 20 years ago we didn't have access to all the data. A lot of the charts were done by hand, and if you wanted to cover a number of different stocks or interest rate markets or currencies, you probably needed more manpower to do that. Whereas now, when you have things like Bloomberg and Reuters where you can automatically just pull data and pull charts very quickly, you don't need as many people to perform that function and do the analysis. And so, to a certain extent, it's limited opportunities, but on the flip side, I think it's also introduced new opportunities because the data is more readily available. What I found that over the last 5 to 7 years, I think there's been an increase in people interested in the quantitative side of behavioral finance and technical analysis. So one of the things I always stress to people that are asking me about job opportunities is not only do you want to learn the basics of technical analysis, the patterns and trend breaks, etc., but try and develop some quantitative background as well in terms of building models, manipulating data, looking at statistics, because that's a great overlay and feed-in into how we can develop new tools to adapt to the investment environment as it changes. So that's a huge opportunity, I think, in terms of where we could see some growth and how we can add value and create new indicators and new ways of looking at the market. So I thought those were the most relevant and interesting areas of questions as part of the panel.